We have a paradox in how we think about money. Take two people on the exact same salary. Curtis avoids debt entirely, guarding a perfect credit score, while his net worth moves in inches. Diego puts himself hundreds of thousands of dollars into debt to acquire income-producing assets, setting a trajectory that a cash-first approach can't match. To be clear, if you are paying 28% interest on a credit card to finance a couch, you have a wealth-eating parasite. Consumer debt drains your accounts, and you have to eliminate it before doing anything else. According to Federal Reserve data, the wealthiest households carry the least debt relative to what they own, roughly 12% compared to 60% for the typical family. The rich borrow less proportionally because they focus every dollar of that debt on what the capital is buying. Good debt is defined by a single metric. It is used to buy assets that either climb in value or generate enough cash to pay for the loan themselves. To understand how this works in practice, we have to deconstruct the three mechanical levers that separate productive debt from consumer traps. The first lever is the multiplier. You use a bank's capital to control an asset while retaining 100% of the appreciation. Consider a $250,000 rental property. You put down $50,000, the 20% equity, and the bank covers the rest. If it rises 5%, it gains $12,500. Using only $50,000 of your own money, that $12,500 gain represents a 25% return. This same multiplier logic applies to buying established, profitable companies. It allows an individual to acquire a business that already has customers and cash flow, rather than starting from zero. The Small Business Administration backs loans that let people buy these cash-flowing operations with as little as 10% down. The operational advantage is specific. The business's own profits are used to pay back the acquisition loan. The asset generates the money required to clear the debt you used to buy it. Multipliers allow you to acquire cash-generating machines for a fraction of their sticker price, using the asset's own performance to build your equity. The second lever is the eraser. This is the process where macroeconomic forces effectively pay off a portion of your debt. When you take out a 30-year fixed-rate loan, the monthly payment amount is locked. That dollar figure is frozen on the day you sign the contract, but the world around that payment continues to change. Inflation drives up the price of food, rent, and standard salaries. This gap shows the systemic advantage of fixed debt. As your income and asset value rise with inflation, that frozen monthly payment becomes a smaller percentage of your budget. You are repaying the loan with dollars that have shrunken in real terms. In this scenario, the Federal Reserve has noted that inflation effectively transfers wealth from the lender to the borrower. The third lever is the shield. The tax code treats consumer debt as a liability, while rewarding productive debt as an investment in the economy. Interest on a personal car loan offers no tax relief. However, interest on a business loan or an investment property is deductible, and depreciation rules allow you to deduct the building's value even as the property appreciates. The most effective version of this is a strategy used by the ultra-wealthy to access cash without triggering capital gains taxes. Instead of selling stocks and paying nearly 20% in taxes, billionaires pledge their shares as collateral for low-interest loans. They get untaxed cash to spend, while their original investments remain in the market to grow. This confirms the hierarchy of sophisticated finance. The wealthy view selling as a last resort, and borrowing as a primary move to protect their capital. This mechanism is a precision tool, and like any tool, it can be destructive. For every success story, there are individuals who borrowed too much at the wrong time and were flattened. Leverage multiplies losses as efficiently as it multiplies gains. During the 2008 crash, millions of owners watched their equity disappear because they were over-leveraged when property values stepped. To use this tool safely, 4 conditions must be met. The asset must out-earn the interest rate. It must be an appreciating or cash-flowing asset. The debt must be survivable during a market dip, and you must maintain the payments. We see the cost of total avoidance in Curtis's original $30,000. Because he kept it in a standard savings account for a decade, inflation ensured that his safe money actually lost value over time. Avoiding all debt provides a sense of security, but it often results in financial stagnation. In the right hands, mathematical leverage remains the primary engine that allows ordinary people to scale their wealth.